Jim, thank you very, very much for that warm introduction. I'm reminded of what Lyndon Johnson used to say when he was so nicely introduced. I wish my parents had been here for that. My father would have appreciated it, and my mother would have believed it. And one of the great glories of coming to a Federal Reserve Bank is that you get introduced without an economist joke. It wasn't so long ago that I was introduced by the guy who said, "Larry, do you know about Einstein's trip to heaven?" And I said, "No, I don't know about Einstein's trip to heaven." And he said, "Well, here's how it went. Einstein went and he really wanted to relate better to people in heaven than he had on earth. And so he met a first guy and said, so we can talk. What's your IQ?" And the guy said 180. And Einstein said, "Fantastic. I've got a new synthesis of quantum and gravitational theory, and I'd like to discuss it with you." And he met a second guy. "So we can talk. What's your IQ?" And the guy said 140. And Einstein said, "Fine. I've been thinking about the real meaning of Shakespeare's sonnets, and I've got what I think are some new ideas that I'd like to share them with you." And he met a third guy. "What's your IQ?" 80. Einstein did not know what to say. And then it came to him, Joel Prakken. He said, "What's your GDP forecast for the second quarter?" So I'm going to try to stick with the tradition of what British Prime Minister Harold Wilson said, name a number or name a date, but never name both. What I'd like to do, and let me actually, before I get into the substance of what I want to say, salute the St. Louis Fed. I was not a fan of hardcore monetarism. I think neo-Fischerian economics has an 80 to 90% chance of being mostly a confusion. But I think it is hugely important to our processes that there be experienced, practical people exploring and pushing doctrines which are counterintuitive to the conventional wisdom. And so I salute the St. Louis Fed, which I think actually has stood out within the Federal Reserve System for nerve and verve in attempting to take on a role of intellectual leadership. And I think it's very, very important. And I've paid as much or more attention, even as I have often not agreed with it, to the research that has come out of the St. Louis Fed as I have to the research that has come out of any other one of the 12 regional central banks. And so, Jim, I salute you on your leadership. I salute your predecessor, Bill Poole, and your predecessors going further back, and the people who have succeeded Homer Jones in the research department. Believe me, you are making a very important contribution to our national life. I have, as some of you may know, been engaged in thinking, writing, provoking, analyzing around the issue of secular stagnation, the issue of protracted, sluggish growth, why it seems to be our experience, and what should be done about it. And what I want to do this afternoon is to rehearse my current thinking on those topics and reflect particularly on the role of monetary policy and what I would have to say are the important limits, in my view, on the efficacy of monetary policy. Start with this. This shows successive estimates of potential GDP, and it shows the behavior of actual GDP for the United States. What you see is that we have a much lower output gap than we did in 2009, but that is wholly the result of the fact that we keep lowering our sights and revising downwards our estimate of potential. Relative to what we thought potential was in 2007, the gap has never been greater. It's actually worse in Europe, where actual GDP has performed worse and the magnitude of the downwards revision has been substantially greater. This is a sobering picture. We in the Obama administration were fond of remarking, and I think we're right to remark, on the contrast between what happened after the fall of 2008 and what happened after the fall of 1929. Basically, collapse and catastrophe happened after the fall of 1929 with the Great Depression. And basically, we didn't have anything like the Great Depression, in part because of the aggressive actions of the Federal Reserve, in part, I would argue, because of the aggressive actions of the Treasury. That was a bipartisan achievement. Key steps like the TARP were initiated during the Bush administration. Further steps like the Recovery Act took place during the Obama administration. But here's the tough thing. Look 11 years out after the beginning of the Depression and look at what our current best guess is as to where the American economy will be 11 years out from the peak at the end of 2007, and it is the same place. If you think the 1930s were a lost decade, we are having an equivalently lost decade. Yes, the economy imploded much more dramatically in the 1930s, but it also recovered more dramatically in the 1930s. Now, at the end of the 1930s, the Harvard economist Alvin Hansen, who was a leading disciple of Keynes, put forward what he called the theory of secular stagnation. And essentially, his idea was that for a variety of reasons rooted in the structure of that time, having heavily to do with demography and having heavily to do with what he saw as the exhaustion of investment opportunity with the end of the American frontier, that there was going to be a tendency in the United States for saving to chronically exceed investment, and therefore for the economy to be short of its full potential a substantial fraction of the time, and for there to be at least some deflationary bias in the economy. Secular referred to the permanence of the phenomenon. Stagnation means stagnation. Now, Hansen turned out to be completely wrong, but completely wrong in a way that suggests that at some future point he could turn out to be right. What actually happened was the Second World War came along. There was a vast increase in demand. The government was a vast absorber of savings by running large deficits, and that propelled the economy very rapidly forward to the point where the unemployment rate went from 12% in 1940 to close to 2% by 1943. It was generally believed that after the Second World War, the economy would go back into depression. That turned out to be wrong. It turned out to be wrong because people forgot that if you weren't allowed to buy a car and you couldn't get credit to buy a house, and then you released all those constraints, you'd have a vast array of saving. It turned out to be wrong because government had a massive project to build out suburbia. It turned out to be wrong because, for reasons that demographers still don't really understand, American women started having an average of 4 children. And so the prediction of a chronic excess of saving over investment that Hansen made didn't seem to be hugely relevant in his period. My thesis is that Hansen was a couple of generations too early, but that the issues he identified can be a chronic problem for capitalist economies, and quite likely are a chronic problem for the economies of the industrialized world today. Here's some data on interest rates as inferred from swaps. One would reach essentially the same conclusions if one looked at government bonds in different countries. The impression you're supposed to form overall is that all the numbers are really little. Start with the nominal interest rates. Low in the United States, extraordinarily low in Japan and Europe. Look at expected rates of inflation. These are not expected rates of inflation this year. These are not expected rates of inflation next year. These are expected rates of inflation over the next 10 years. Nowhere do markets think that central banks are going to get even very close to their 2% inflation targets. And perhaps most striking is what the expectation is of real interest rates. That is, of inflation-adjusted interest rates. That is, of the terms for which one can exchange purchasing power this year and purchasing power in the future. The real interest rate in the industrial world is essentially zero. Now, you can argue and debate about risk premiums and liquidity premiums. Should you use swaps or should you use government bonds? And if this were a different kind of discussion, we could have a rich technical discussion of those questions. We would not escape the conclusion that for the industrialized world, markets are telling us that for 10 years, we're not going to get to the inflation target, and we're not going to get to anything like what we have traditionally thought of as normal real interest rates. Hint as to where I'm going. If you thought there was a big increase in saving and there was a big reduction in the investment propensity, then you would expect that interest rates would fall very dramatically, and you would expect to see downwards market pressure on interest rates. And so this is a market judgment that the secular stagnation hypothesis is true. Now, markets have come to this judgment slowly and painfully. What this chart shows is what the markets thought was going to happen to short-term interest rates. And there's an old joke about the price of shale oil. This joke no longer applies, but there was an old joke about the price of shale oil, which is it's been constant for 40 years. The current price of oil plus 10. And in the same way, the view of the market has been normalization is 6 to 9 months away and will take place at a reasonably rapid rate. And that has been the consistent view of the market since 2009. The only major group, and that view has been an exaggeration, a massive exaggeration with respect to what happened. The only people who have been more out of touch with reality in expecting an increase in interest rates than the market has been the Federal Reserve. What you see is that the Federal Reserve has consistently been above the market, particularly in the last couple of years, and has been in the process of an ongoing downwards revision. So what I want you to think about as we go forward is that the evidence is overwhelming of unusually stagnant growth, and the evidence is overwhelming that there is a market expectation of extraordinarily low inflation and extraordinarily low real interest rates going forward. And by the way, if you look at the swap curve, which is an attempt to forecast federal funds, it's saying that rates are never going above 2%. Now, here's the next thing to appreciate. This is not all about the financial crisis. This is not all about the current business cycle. There has been a trend for as long as we can measure it, as long as there have been index bonds to use to measure it, downwards of real interest rates over the long term. Indeed, if you look at this graph and you take the period before the financial crisis through to sometime in the 2007 period, and you simply extrapolate it, you more or less predict the general area in which real interest rates are today. This is not an artifact of near-term developments or of particular things that the Federal Reserve is doing. If you look at U.S. real rates, the so-called five-year, that is the market expectation of what the 5-year real interest rate will be 5 years from now. So it's not about anything ephemeral or current. It's essentially the same picture of a very substantial and continuing decline over the longer term. Capital is mobile around the world, so you'd expect that something like this would be a feature of the industrial world as a whole. And sure enough, if you look at the 10-year yield, adjusting for expected inflation, actually even going back before the late 1990s, you find exactly this picture of a sharply and continuingly declining real interest rate. What is the natural way to explain these phenomena? The natural way to explain these phenomena, I would suggest, is to imagine that there have been a set of forces that have pushed up the savings propensity, pushed down the investment propensity, and therefore the interest rate that has been necessary to equilibrate them has been under substantial downwards pressure, and then at some points they haven't been equilibrated. And so the mechanism that equilibrated them with excess saving and insufficient demand has been a lower level of income than would otherwise take place. Is that a plausible view? Well, one way to answer the question, I don't think it's ultimately the most persuasive way to answer the question, is to try to measure what the neutral real interest rate is, to try to measure what the intercept, for the technical among you, is in the Taylor rule. Or more prosaically, to ask, well, when the economy's normal, what real interest rate do we observe, and has that changed? So if the economy seems to be running too hot, we figure the normal real interest rate is lower than when it currently is. If the economy seems to be running cold, if the economy's hot, we figure the normal real interest rate is above the then current rate. If the economy is running cold, we figure the neutral rate is below the then current real rate. So a variety of econometricians have attempted to do this, and look what they conclude. The typical estimates are that the current real rate is substantially negative. And the estimates are that the real rate has been trending somewhat downwards over time. The Fed has noticed, and the Fed over the last few years has revised downwards its estimate of the neutral real rate, but the Fed's adjustments are pretty pale compared to the trends that the market is seeing as reflected in long-term real rates, and they're pretty pale compared to the adjustments that are suggested by the econometric estimates to measure neutral real rates. So what I haven't said, and what's maybe the most important question for thinking about what I'm saying or thinking about these issues, is, well, what is it that's caused savings to rise and investment to decline, and therefore to create this downwards pressure, this tendency towards stagnation? Well, when you think about it, there are actually a plenitude of factors that could bring this outcome about. Increases in savings propensity might be expected to come from rising inequality and the observation that the rich save more of their income than the poor. Might be expected to come from what we know we've seen, very substantial reserve accumulation in developing countries, and from some developing countries, notably China in the last 9 months, very substantial capital flight. Indeed, the capital flight from China over the last 9 months has been, depending on just how one does the measurement, about 3 times as large as all the capital flight from all the emerging market crises of the 1990s. Longer life expectancy, more resistance to debt, more uncertainty, household deleveraging, paying back debt is a form of saving. What about the investment propensity? Well, the labor force of the industrialized world is not going to grow over the next 20 years. That's got to say something about the demand for new equipment to equip them. That's got to say something about the demand for new housing to house them. That's got to say something about the need for new business structures to give them a roof over their heads as they work, operating for less investment. Think about the demassification of the economy. I was speaking with somebody in real estate not long ago who said that 15 years ago, a good law firm, would require 1,300 square feet per lawyer. That today there are at least some law firms that are trying to have less than 600 square feet per lawyer. You don't need nearly as many filing cabinets as you once did. You don't need nearly as many paralegals as you once did. You don't need nearly as many assistants as you once did. You may not need as large offices, since people are likely to spend more time with their laptops working at home. All of that means downwards pressure on physical investment. Think about e-commerce and the demand for malls. Think about Airbnb and the demand for hotels. Think about Uber and the driverless car that will come, and the demand for the number of automobiles. All of this operates, and people have tried to measure this since Alan Greenspan first measured it in the 1990s, the total number of pounds of stuff per dollar of GDP is in a secular downwards trend. And since a lot of that stuff is capital, that means less investment. Capital goods are getting cheaper relative to other goods. Think about, most obviously, anything to do with information technology. And that means $1 of saving buys a lot more capital than it used to. And that reduces the demand for capital as well. And there are other factors as well. The fact that financial intermediation works less efficiently because people are more nervous, both because of what happened and because of regulation, operates to push interest rates down. All of this taken together makes it highly plausible, I would submit, that we have seen a very substantial and structural increase in saving and decrease in investment, resulting in low rates, resulting in a tendency towards economic sluggishness. In important respects, this is the deep cause of the financial crisis. After all, think about the 2003 to 2007 period. The economy did fine overall. It didn't overheat. It didn't perform spectacularly. It did fine. And yet, what did it take to propel it to fine? It took what we now see as having been a vast erosion of credit standards, and what we now see as the mother of all bubbles in the housing market. Without those things, growth would have been inadequate in 2003 to 2007. Or to put the point differently, if the economy had been overheating, the Fed would have provided the interest rate increases that would have cut off the housing bubble much sooner. And so this structural tendency towards too much savings relative to investment is both the reason why we have sluggishness now and is the reason why the periods of robust growth increasingly prove not to be sustainable. Indeed, here's a potted version of American economic history. We've had very slow recovery. Before that, we had the financial crisis. Before that, we had growth on what we now know to have been an unsustainable financial foundation. Before that, we had the 2001 to 2003 recession and slow recovery. And before that, we had rapid growth propelled by the internet bubble. And so if you ask, when was the last time that the American economy grew at a rapid rate with clearly strong financial underpinnings, you have to go back close to a generation to find that time. And the underlying reason is this excess of saving over investment. Now, the Federal Reserve has been given through most of this period to say, well, the economy is held back by headwinds, but the headwinds will recede as the recovery continues, and then we'll be in a position to normalize rates. That's what was behind, that's the view that was behind all those dotted lines showing rate increases. That was a very reasonable thing to think and say in 2009 or 2010. There were all kinds of huge aftershocks and after effects of the financial crisis. It may well have been a reasonable thing to say in 2011 or even in 2012. But 4 or 5 years after the financial crisis, it was hard to understand what was the headwind that you could reasonably expect to recede in the next 2 or 3 years. And the answer is that it wasn't a temporary headwind. It was a permanent headwind driven by the factors that I have just described. Now, some braver econometricians than I at the Bank of England have attempted to quantify each one of these factors and forecast each one of these factors, and Lukasz Rachel and Thomas Smith to make a judgment quantifying what will happen in the future. And essentially their judgment is that on a global basis, real rates declined 400 basis points between 1980 and 2015, and that there's no particular reason to think that any significant part of that is coming back over the next 15 years. I think there's a good chance that that judgment is correct. More saving, less investment, very low interest rates, problematic financial sustainability, and a tendency towards economic weakness. That is the secular stagnation hypothesis. Now, there's some alternatives to it. Some of them are kind of the same, and some of them, I think, are incomplete or inadequate as an explanation. My Harvard colleague, Ken Rogoff, talks about a debt supercycle coming to an end and the need for deleveraging. Good story about 2011. Not a very good story 8 years after the crisis, when financial conditions seem very much to have normalized. Also, not a story that explains why there's been a secular downward trend in real interest rates for between 20 and 30 years, and that trend pre-crisis tracks the current level of real interest rates. Bob Gordon suggests, importantly, that there's a great deal of structural weakness on the supply side. that whatever happens with demand, the economy's potential is rising less rapidly than it once did. And there's powerful evidence for that. The fact that GDP growth has been very weak, but that unemployment is really quite low, suggests that something very bad has happened to productivity. And that may well have to do with the various factors that Gordon described. Notice, however, that economists have a classic test for telling whether something is a supply phenomenon or a demand phenomenon. If the price of apples go up, and you want to know whether it's because there's a shortage of apples or because apples have come into fashion, you look at what happens to the quantity of apples. If the price of apples has gone up and there are a lot more apples being sold, then you figure it's because there was more demand. If when the price of apples goes down, the supply, when the price of apples goes up, the quantity of apples goes down, you figure there was a problem at the orchards. What have we seen? We have seen steadily declining rates of underlying inflation in the industrial world. And as best we can measure them, long-term inflation expectations, despite the recovery, are very low by historical standards. So yes, there are supply issues, but I think it would be a mistake to explain everything in terms of supply issues. The last time there were major supply issues, we had the 1970s. And we certainly don't have anything like that in terms of inflation. Former Fed Chairman Ben Bernanke has suggested that it has something to do with a savings glut. I don't really want to argue with that. A savings glut is, after all, a lot like an excess of savings over investment, which is what I've been talking about. Bernanke sees the problem very much in terms of excess saving in developing countries. I look at the length of the trend, the variety of other factors that we've seen, and I think that is an incomplete view. Finally, Paul Krugman and others talk about the liquidity trap. Again, the liquidity trap is closely related to the difficulty in lowering interest rates enough to balance savings and investment that I have been talking about. But the liquidity trap is usually, and in all of Krugman's formal modeling, is treated as a temporary phenomenon. And it's the essence of my argument that this excess of saving over investment may be a phenomenon for the next era, not simply a temporary and cyclical phenomenon. Here's why this is a critical problem that should be a focus of concern for policymakers in the United States. I don't know when the next recession is going to come. If you simply take the prevailing Fed forecast and you say, well, the forecasts have error in them, and given the error, what are the odds that there'll be a recession? If there's a normal level of error, you'd say that it was about 1 in 6 this year and about 1 in 3 over the next 2 years. This is a somewhat dated forecast. I'll bet my friends at Macroeconomic Advisors are less optimistic about the 4 quarters of 2016 right now, since the first quarter is going to be 1%. So if you revise these numbers to be right up to date, I suspect you'd get a number closer to 40 or 45% for the next 2 years. But another way to do the question is to just ask, what are the odds, if an expansion's been going for 3 years, that it will end sometime in the next 2 years? And here's the answer to that question. So you can interpret this data differently. I think it's hard to escape the conclusion that the odds are better than 50% that within 3 years the U.S. economy will have gone into recession. Now, here is the problem. Here's the decline in the real federal funds rate when the economy goes into recession. It's averaged 5 percentage points. If I looked at the nominal federal funds rate, I would get about the same answer. Now, given what I have been saying, given what the market is saying about future interest rates, there is no realistic chance that when the next, no, I shouldn't say there's no realistic chance. It is highly unlikely that when the next recession comes, there will be anything like enough room for the standard monetary policy response. Our strategy for the last 40 years has been to respond to recessions with monetary easing. That monetary easing has typically been about 5 percentage points. And a best guess of the market of where interest rates will be when the next recession comes is that they will be at 2%. And so even if you assume that the next recession is typical and no worse, you will either have to rely very substantially on unconventional monetary policy or something else. Now, what are the monetary policy options that one can talk about? The Fed has expressed the view, and by the way, when you have responsibility for something and you're in government, it's a good idea to look like you kind of have the problem under control, even if you're not altogether certain that you do. So I don't fault the rhetoric of the Fed, but I do not think it is remotely realistic to think that there is anything like the equivalent of 300 basis points in unconventional monetary policy that is likely to be available when the next recession comes. What are the tools that people talk about? Principally, there are 4. There's an argument that you should raise the inflation target. That it will be an interesting and important issue at some point, but it's like discussing whether I should lose 40 pounds or lose 60 pounds, a much more interesting issue after I've lost the first 20. And when we can't get to 2, discussing whether optimal is 3 or 4 or 5 seems a tad jejune. There is the idea of forward guidance. This is the suggestion that the Fed can promise that it's going to keep rates low in the future, and that will make longer-term rates low and will make everybody optimistic and will make them spend. Here's the problem. People already don't think the Fed's going to raise rates very much. There's not much more to promise than what has already been promised. People are already betting that rates aren't going above 2. Limited scope there. There's broader quantitative easing. Now, I think quantitative easing was very effective at the beginning when there was substantial illiquidity in many fixed income markets and when there were large credit spreads and steep term premia. When there aren't steep term premia and when there aren't large credit spreads, what is it that you are what rates is it that you are actually going to reduce substantially? What is the quantitative easing program that's starting with a treasury rate of 1.73 is 10-year treasury rate of 1.73 is going to do anything like what a normal 3 or 5 percentage point reduction in interest rates will accomplish? And finally, there's the idea of a venture into negative rates, which it seems to me is a quite uncertain experiment. Andy Haldane at the Bank of England says he's made a fairly thorough study of this, and there's interest rate data going back to Babylonian times, and there's no historical experience with negative rates. But in a world where you can put $20 bills in a suitcase, or $100 bills in a suitcase, maybe you'll make rates be negative 30, maybe you'll make rates be negative 60. It's not all that big relative to what's necessary the next time a recession comes. So there's a real question as to how effective unconventional monetary policy can be. But even if it could be effective, there are two other major problems with unconventional monetary policy. The first is what I would call the pull forward problem. The pull forward problem is that the way monetary policy works is by pulling spending forward. When the interest rate's lower, you buy a new car sooner than you otherwise would. When the interest rate's lower, you invest a lot in order to adjust your capital stock to a higher level because the interest rate's lower. So if you have a temporary demand shortfall, a reduction in interest rates is terrific because it pulls forward demand to the moment where you have the shortfall. But if you have a permanent demand shortfall, at some point, that pull forward catches up with you. At some point, yes, we increased demand in 2015, but the way we did it was by pulling demand from 2016 into 2015. And so unless you're going to have ever easier monetary policy, at some point the treadmill catches up with you. And then there's this. What is the consequence of the spending you're generating with these unconventional hyperliquidity measures? They are surely increasing the risk of making the mistakes of 2005 to 2007. They are surely have questions about the quality of the investment that people are not willing to make with a 1.75% 10-year rate that they would be willing to make with a 1.25% rate. My conclusion is not that the Federal Reserve has been wrong to try to respond to slack deflationary pressure and excess of saving over investment by letting interest rates and letting financial conditions adopt. My conclusion, though, is that that process has surely run into very severe diminishing returns and cannot be relied on the next time a recession comes. What is the implication of that? I would suggest two. A first implication is that surely it is very important to avoid the next recession coming anytime soon. That one should be prepared to take risks that one would not take in normal times to avoid recession. That the possible risks of recession and entrenched inflation expectations below 2% vastly exceed in terms of their consequences, a hypothetical situation in which inflation rose to 2.3 or 2.7%, and that awareness needs to be important in the setting of monetary policy. Second, normalization is the wrong objective in abnormal times. Normalization relative to historical experience is not appropriate in conditions where the natural, neutral, normal, whatever you want to call it, interest rate is very different than it has been historically. More profoundly, in the world we have lived, changes in demand, whether they come from what happens in the rest of the world, whether they come from changes in trade policy, whether they come from tax reforms, whether they come from fiscal policies. We have assumed that changes in demand can naturally be offset by the workings of monetary policy. And so when we have analyzed policy areas, we have abstracted from those changes in demand. In a world where monetary policy is much more limited in its impacts, we will need to think much more carefully about the demand aspects of all other policies, because they will not naturally be sterilized by the actions of the Federal Reserve. In that regard, I would just conclude by saying that I believe we need a radical rethinking of the role of fiscal policy in economic stabilization. That with monetary policy able to do much less, fiscal policy will need to do much more. That we need a rethinking of fiscal policy that reflects the fact that the sustainability of debt depends crucially on a comparison of interest rates and growth rates. And when interest rates are chronically and systemically low, debt burdens that would otherwise become imprudent become much more prudent in the context of an economy that is growing. And I would conclude by observing that a moment when money has never been cheaper, a moment when materials costs are near record lows, a moment when those with the capacity to do construction work are still out of work in disproportionate numbers, it is difficult to imagine a better moment to stop paint chipping off school buildings or to fix LaGuardia Airport. And the United States right now has the lowest infrastructure investment rate that it has had since the Second World War. And that if you adjust for depreciation and round to the nearest integer, that investment rate is zero. And that seems to me manifestly inappropriate. And the only thing that is more wrong than our current low infrastructure investment rate is the absence of any systematic planning to rapidly build up and launch infrastructure when the next recession comes. And so we need to adopt to a world that is very different than the world that we have known. A world where the problems are as much of deflationary risks as of inflationary risks, of insufficient demand as of inadequate supply, of limits on the power of monetary policy, and a world where fiscal policy Whether, if you have my kind of views, that's fiscal policy directed at public investment, or if you have other views, it's fiscal policies directed at stimulating private investment. This is not a matter of political ideology, but it is a matter of economic reality. A moment of very different economic conditions will require very different economic policy responses. And that's something both those charged with monetary policy responsibility and those who create the political frameworks in which monetary policy operates need to keep very much in mind in this era of secular stagnation. Thank you very much.